little bit about the line of credit, or kind of, because
Yeah.
when we had talked earlier, it was, we've have terms of line of credit, reverse mortgage, and when I think of line of credit, what automatically comes to mind is, I go to the bank, I get an open-ended line of credit, and I get a certain interest rate on it, and if I use it, I don't have to use it. But if I do use it, then I can draw on it and pay the interest based on, whatever I've drawn on. So explain a little bit about how that works with reverse mortgage, as far as the line of credit and how that's structured.
Right. So the line of credit is typically a HELOC in our business, right?
Mm-hmm.
It's a home equity line of credit. And with that, we talked about this earlier, is that the HELOC is vulnerable to the bank saying in bad times, we can either reduce it, the home equity line of credit, or we can completely eliminate it. And with that, on a HELOC, like you said, if you make a draw on it, you actually make a payment on it, right? So it's actually becomes a liability. With a reverse mortgage, again, hence the term reverse, it's completely opposite. So let's give an example for the visual. So let's say, for example, the house is worth $500,000. You owe $100,000 on the house, but because of your age, and because of the expected rate, and because of the value of the property, you actually qualified to get in the reverse mortgage a total of $250,000. Well, if you owed $100,000, that would be paid off, and you would have left. You have that $150,000 left, which would be in the line of credit. That line of credit is something that you can use at your discretion. Okay, and there's some other rules built into it, but that line of credit is something you can use at your discretion that you, again, never, ever make a payment on. So if you use all $150,000 over a period of 2 years or 3 years or 10 years, you will never make a payment on that because that's included in your reverse mortgage. And by the way, those funds are tax-free. Just like on a traditional cash out refi, you don't pay tax on the equity in your home when you pull out the money. The other additional thing that's really super important about a line of credit is that right now the going rate is between 6.5% for a reverse mortgage. Okay, so there's two things to think about there. That line of credit that started in our example tonight at 150,000 would grow if that 6% was to stay right consistent. Will grow at 6% every single year until that 6% change. It could go higher, it could go lower. But you're always going to get a return on that line of credit. Whatever the unused portion or the portion that you haven't drawn, it's always going to go up by that 6% or that 4% or that 5%. So that line of credit grows, unlike a HELOC, which stays stagnant. There's no interest rate that's tacked onto your HELOC where it's actually going to grow in value.
Right. And so what I find very interesting with the reverse mortgage setup is that if my house value goes down, for example, I'm going to be subject to my bank coming after me and saying, hey, we're going to reduce your line of credit because the values have gone down.
Right.
So now we are going to lower your line of credit, which can affect my credit. Yep. And cause other repercussions. So from a reverse mortgage standpoint, it sounds like that's not even relevant in this case. It doesn't even happen that way, right?
The value of your home could go to zero, right? Could go to zero because of market factors, and that's an extreme case, right? Sure. And if your line of credit was 150,000, just to prove the point, your line of credit would remain 150,000 and continue to grow by whatever that interest rate is, the prevailing interest rate at that time.
So that really gives a lot of security. I would imagine that, that can really give you a lot of security in knowing that you're not going to necessarily, have the bank running after you if your home values go down for whatever reason, right?
Yeah, there's zero risk with your line of credit and it ever going down if you don't use it.
Right.
Zero.
So if I'm in my retirement, and I, am set up on a reverse mortgage, that this is where I'm gonna stay put for the rest of my life. Yep. That is a really big selling point for me if I'm putting myself in that situation, that I don't have to worry about that, right? So I can focus on other things in my life. I can focus on my family. I can focus on other financial goals that I have. I don't have to worry about the fluctuation of the market, with my mortgage having to change, unless of course I decide to change it. But as long as it stays put, then I'm basically set for the rest of the, for the rest of my time. I mean, so that's such a huge benefit.
Yeah.
It gives somebody such a peace of mind, I would think.
Yeah, it's like an insurance policy,
Yeah.
right?
Yeah.